Somewhere in a quiet conference room in Washington, 12 people sit around a polished wooden table. They speak softly. They sip coffee. And in the span of about an hour, they decide the price of money for 330 million Americans, and indirectly, for almost every borrower on Earth. They do not own the factories. They do not run the supermarkets. They do not vote on your taxes. And yet, when this committee adjusts a single number by even 0.25%, mortgage rates shift, car loans tighten, credit cards bite harder, hiring freezes begin, stock markets convulse, and entire countries on the other side of the world feel the tremor in their currencies before the sun rises. That number is called the federal funds rate. It is the most powerful financial lever ever invented, and almost nobody outside of finance truly understands how it works, or why it has the strange ability to reach into your bank account, your job, and even the cost of the eggs on your kitchen counter. This is the story of how interest rates came to control everything, not through force, not through legislation, but through a quiet, mathematical chokehold on the one thing every modern human depends on, whether they realize it or not: money itself. Strip away the jargon, and an interest rate is simply the rent you pay to use someone else's money. If you borrow $1,000 at 5% for a year, you are essentially renting that $1,000, and the rent is $50. Simple, almost mundane. But here is where the picture changes. The lender is rarely a single person with a stack of cash. The lender is a bank, and the bank itself does not get its money from a vault full of gold coins. The bank borrows too. It borrows from depositors. It borrows from other banks overnight, and ultimately, the cost of all that borrowing traces back to one anchor rate, set not by the market, but by a central authority. When that anchor moves, every other rate in the economy moves with it. Mortgage rates, auto loans, business credit lines, government bonds. Even the yield on the savings account that pays you almost nothing. Everything is tethered to the same invisible string. So when you hear that the central bank raised rates by 0.5 percentage point, what really happened is that the cost of renting money just went up for everyone, all at once, in every corner of the economy. The price of patience changed. The price of risk changed. The price of the future itself changed. To understand how rates became so dominant, we have to travel back to 1913, the year the United States Federal Reserve was created. Before that, America had endured nearly a century of brutal banking panics. Banks would fail in clusters. Depositors would line up in the cold, banging on locked doors, hoping to retrieve their savings before the next institution collapsed. In response, Congress designed the Federal Reserve as a lender of last resort. The idea was simple. When ordinary banks ran out of cash, the central bank would lend to them, calming the panic before it spread. To do this, the Fed needed control over one specific thing: the cost of borrowing between banks. That cost became known as the discount rate, and later evolved into the federal funds rate. What started as a quiet emergency tool quickly grew into something much larger. By the 1920s, central bankers realized that by adjusting this rate, they could influence not just bank stability, but the entire pace of the economy. Cheaper money meant more borrowing, more building, more hiring. More expensive money meant the opposite. And so a new kind of power was born. A power that did not require an army, a prison, or a courtroom. A power exercised entirely through arithmetic, through a single number, broadcast at exactly 2 in the afternoon, 8 times a year. Let us bring this down to your kitchen table. Imagine you want to buy a house priced at $400,000. You put down 20% and finance the remaining $320,000 over 30 years. At a mortgage rate of 3%, your monthly payment is around $1,349. Manageable, predictable. The kind of payment that lets you also save for retirement, put your kids through school, and take a vacation now and then. Now move that rate to 7%. The exact same house, the exact same loan amount, the exact same neighborhood. Your monthly payment jumps to roughly $2,129. That is nearly $800 more every single month for 3 decades. Across the life of the loan, you will pay an extra $280,000 just because the central bank moved a number. This is why housing markets freeze the moment rates climb. Buyers vanish. Sellers refuse to list. Builders stop building. And homeowners with low locked-in rates from the cheap money era refuse to move. Because giving up a 3% mortgage to take on a 7% one feels like financial self-harm. The entire housing economy ossifies, all because of one decision made in a room 1,000 miles away. Now scale that same logic up to corporations. Every major business in the world runs on credit. Apple borrows. Walmart borrows. Even cash-rich tech giants borrow, because debt is often cheaper than using their own money. When rates are low, a company can borrow $1 billion, build a new factory, hire 10,000 workers, and still earn a profit, because the cost of servicing that debt is minimal. Innovation becomes affordable. Expansion becomes obvious. Risk becomes rational. But raise rates by even 3 or 4 percentage points, and the math inverts. That same billion-dollar loan now costs an extra $30 or $40 million a year just in interest. Suddenly, the new factory is no longer profitable. The hiring plan is shelved. The innovation budget is cut. The marginal projects, the ones that would have produced the next breakthrough product or the next 1,000 jobs, simply do not happen. Multiply this across millions of businesses, and you get the strange phenomenon economists call monetary tightening. It feels invisible. There are no new laws, no new taxes, no new regulations, and yet investment slows. Hiring slows, wages stagnate, and a recession quietly begins to assemble itself, brick by brick, in the shadow of a single rate decision. Stock markets are essentially machines that price the future. When you buy a share of a company, you are not really buying its current profits. You are buying a claim on every dollar that company will earn from now until the end of time, discounted back to what those future dollars are worth today. And the discount used in that calculation is, you guessed it, the interest rate. When rates are low, future dollars are valuable because the alternative, parking your money in safe bonds, pays almost nothing. So investors pile into stocks, especially growth stocks, whose biggest profits lie far in the future. Valuations soar, tech booms. Everything feels invincible. But raise rates, and the math flips violently. Future dollars are now worth far less in present terms because safe bonds suddenly offer a real return. The stocks that depended most on distant future profits, the high-flying technology names, the unprofitable startups, the speculative growth bets, fall the hardest. Trillions of dollars in market value can evaporate in months, not because the companies got worse, but because the discount rate got higher. This is why every word from the central bank chair is dissected like a holy text. A single phrase, a single shift in tone about future rate moves can erase or create more wealth in an afternoon than entire wars have destroyed in years. Now widen the lens to the global stage. When the United States raises interest rates, it does not just affect Americans. Money is global. Capital flows toward whichever country offers the highest safe return. So when American rates climb, investors all over the world sell their local currencies and buy dollars, chasing those higher yields. The dollar strengthens. Foreign currencies weaken, and suddenly countries that borrowed in dollars, which is most of the developing world, find that their debts have grown enormously in their local terms, even though the original loan amount has not changed by a single cent. Argentina has lived this story repeatedly. Turkey has lived it. So have Egypt, Sri Lanka, Pakistan, Ghana, and dozens of others. Their citizens wake up to find that imported food costs 30% more, that fuel is unaffordable, that their savings have lost half their purchasing power, and that their government is suddenly negotiating emergency loans with the International Monetary Fund. All of this triggered not by anything those countries did, but by a meeting in Washington. The federal funds rate is, in many ways, the most powerful single number in the global economy, and it is set by people the rest of the world never voted for. If this is the kind of hidden machinery you want to understand more deeply, the kind of system that shapes your life without ever asking your permission, then take a moment right now to subscribe to Ledger Cipher. Every video on this channel pulls back the curtain on the financial structures most people never get to see. Hit the subscribe button, ring the notification bell, and let us continue decoding the world together. It costs you nothing, and it helps us keep digging into the systems that quietly run your life. So why would any central bank deliberately raise rates and risk all of this damage? The answer almost always is inflation. When prices rise too quickly, the value of every dollar in your wallet shrinks. Wages fail to keep up. Savings erode. Pensions buy less. Social trust frays. To kill inflation, central banks have only one real weapon: raise the cost of money so high that demand collapses. If borrowing becomes painful, people buy fewer cars. Companies build fewer factories. Households cut back on travel and dining. With less demand chasing the same supply of goods, prices stop rising. This is the brutal logic that drove the famous Volcker shock of the late 1970s and early 1980s, when Federal Reserve Chairman Paul Volcker pushed interest rates above 20% to crush double-digit inflation. He succeeded, but at a cost. The economy plunged into a deep recession. Unemployment soared past 10%. Farmers lost their land. Steel towns hollowed out. Entire industries vanished. And yet, in the long view, Volcker is remembered as a hero because the alternative, runaway inflation, would have been even more destructive. This is the cruel arithmetic that every central banker eventually faces. Pain now or catastrophe later. Then came the opposite extreme. After the 2008 financial crisis, central banks slashed rates to nearly zero and held them there for almost a decade. Their goal was to revive a wounded economy. The result was the strangest financial environment in modern history. When money is essentially free, everything strange becomes possible. Companies that had never made a profit could raise billions of dollars from eager investors. Real estate prices in major cities doubled and tripled. Cryptocurrencies rose from obscurity to trillion-dollar market caps. Art, wine, classic cars, and even cartoon images of apes traded for fortunes. Risk became invisible because the price of safety was zero. Pension funds, desperate for the returns they used to earn from bonds, were pushed into riskier and riskier corners of the market. Mom-and-pop investors, lured by zero-commission trading apps, poured into speculative stocks they barely understood. The entire global financial system rearranged itself around the assumption that money would always be cheap. And then, when inflation finally returned with a vengeance in 2022, central banks reversed course faster than at any time in modern history. The era of cheap money ended in the span of about 18 months. The hangover from that party is still being paid for in collapsed startups, broken regional banks, and frozen housing markets all over the world. Here is where interest rates take on a darker dimension. Governments borrow too. The United States carries roughly $36 trillion in national debt. When rates were near zero, the interest on that debt was almost manageable. The government could roll over its borrowing cheaply, year after year, with relatively modest interest payments. But raise rates, and that same mountain of debt becomes vastly more expensive to carry. The United States is now spending over $1 trillion a year just on interest payments. That is more than the entire defense budget, more than Medicare, more than every federal investment in research, infrastructure, and education combined. And every dollar spent on interest is a dollar that cannot be spent on schools, hospitals, bridges, or scientific research. It is a silent transfer of wealth from taxpayers to bondholders. A transfer that grows automatically every time rates rise. Worse, this creates a trap. To control inflation, the central bank wants to keep rates high. But to keep its own debt affordable, the government desperately wants rates low. The two goals collide. And in that collision, the independence of the central bank itself comes under enormous political pressure with consequences that historians will be debating for generations. Spare a thought now for savers, people who did everything right. They worked hard, lived below their means, and tucked money away in savings accounts and bonds, expecting modest but reliable returns to fund their retirements. During the long era of near-zero rates, those savers were quietly devastated. Their savings accounts paid almost nothing, while inflation slowly chewed through their purchasing power. A retiree with $1 million in the bank, who once could have lived comfortably on the interest alone, suddenly found that interest produced barely enough to cover groceries. Meanwhile, those who borrowed aggressively, who bought real estate with cheap loans, or speculated in stocks on margin, were rewarded handsomely. The system effectively punished prudence and rewarded risk-taking for more than a decade. Now that rates have risen, savers finally earn something again. But the damage to their long-term plans has already been done. And the lesson is uncomfortable. In a world where central banks can change the rules at any moment, even the most disciplined financial behavior can be undone by a policy decision made in a room you will never enter. Return now to the global picture. When American rates rise, capital floods out of emerging markets and back into United States bonds. Local currencies collapse. Foreign debt becomes unpayable. Imports become unaffordable. And the populations of these countries, often the poorest people on earth, pay the price for monetary decisions made thousands of miles away. Sri Lanka offers a haunting recent example. After years of borrowing in dollars at low rates, the country was crushed when global rates rose and tourism collapsed. By 2022, citizens were waiting in fuel lines for days. Hospitals ran out of medicine. The government defaulted. Protesters stormed the presidential palace. A nation effectively went bankrupt, and interest rates were a major reason why. Egypt, Pakistan, Argentina, Lebanon, Ghana, and many others have walked variations of the same path. The cycle is brutally consistent. Cheap dollars flow in during easy money periods. Governments and corporations borrow eagerly, and then when rates rise, the tide reverses, leaving the borrowers stranded on the rocks. This is why economists sometimes call the federal funds rate the most exported American product in history. It is felt everywhere, even in places that have never bought a single American car or watched a single American film. Interest rates also quietly shape inequality. When rates are low, asset prices, the prices of stocks, real estate, and businesses tend to soar. The people who own those assets, mostly the already wealthy, get richer almost effortlessly. The people who do not own them, mostly the young and the working class, watch the cost of homes and shares race away from their reach. When rates rise, the same dynamic unfolds in reverse, but the damage is uneven. The wealthy can absorb temporary asset price declines. They have diversified portfolios, fixed-rate mortgages, and emergency reserves. The working class, by contrast, often holds variable-rate debt, faces immediate squeezes on rent and food, and has no buffer to wait out the storm. Over decades, this asymmetry has helped fuel one of the largest wealth gaps in modern history. The top 10% of American households now own roughly two-thirds of the country's wealth. And while interest rates are not the only cause, they are one of the most powerful invisible forces shaping who gets ahead and who falls behind. It is one of the great unspoken truths of modern finance. The same lever that fights inflation also reshapes the distribution of wealth every single time it moves. Banks themselves are extraordinarily sensitive to rates. They borrow short and lend long. They take in deposits that can be withdrawn at any moment, and they lend that money out as 30-year mortgages, multi-year business loans, and long-dated bonds. When rates rise sharply, the value of those long-term loans on their books falls, sometimes catastrophically. This is exactly what happened in early 2023, when Silicon Valley Bank collapsed in a matter of days. The bank was sitting on enormous unrealized losses on long-term bonds it had bought during the cheap money era. When depositors panicked and tried to withdraw their funds, the bank had to sell those bonds at a loss to raise cash, and the losses became real overnight. Other regional banks fell in the same wave. Signature Bank, First Republic. Each one a casualty, in part of the most aggressive interest rate hiking cycle in 40 years. The damage rippled into commercial real estate, into private credit markets, into pension funds holding similar bonds. The full bill is still being tallied, and this is the hidden danger of fast rate moves. Even when the policy intent is correct, the speed of change can break institutions that were built for a slower world. The financial system is a giant interconnected web, and yanking on one strand always risks snapping another. Modern central banking has evolved into something resembling theater. Every word the chair of the Federal Reserve speaks is passed, analyzed, and traded on within seconds. Hedge funds employ entire teams to study tone, body language, and word choice. Algorithms scan press conferences in real time, trading billions of dollars based on subtle shifts in phrasing. This is called forward guidance, and it is now arguably as powerful as the rate decisions themselves. By signaling what they intend to do months in advance, central bankers can move markets without changing rates at all. A hint that cuts might come sooner can ignite a rally. A warning that hikes might last longer can crash an entire sector. It is a strange new form of power. The most influential financial actor on Earth now governs not just by changing numbers, but by carefully managing expectations about what those numbers might one day be. The future is priced before it arrives, and it places enormous responsibility in the hands of a small group of unelected officials. Their words alone, regardless of their actions, can transfer wealth, trigger layoffs, or save institutions. The microphone has become the lever. For all its power, the interest rate is also a remarkably blunt instrument. It cannot target specific industries. It cannot fix supply shortages caused by wars or pandemics. It cannot force innovation. It cannot rebuild trust in a broken political system. It can only raise or lower the cost of borrowing for everyone, all at once, regardless of who needs help and who needs restraint. This is why central banks often face an impossible choice. If inflation is being driven by oil prices because of a foreign war, raising rates will not produce more oil. It will simply punish workers, homeowners, and small businesses by making their lives more expensive, while doing little to address the actual cause. And yet, with no other powerful tool at their disposal, central banks raise rates anyway, because doing nothing would risk allowing inflation expectations to become entrenched. The result is a kind of monetary tragedy. The right tool for one problem becomes the only available tool for every problem, and ordinary people bear the cost of that mismatch. It is a humbling truth. The most powerful number in the world is also, in many ways, one of the crudest. Looking ahead, the role of interest rates is only going to deepen. Governments are more indebted than at any time since World War II. Asset markets are larger and more interconnected than ever before. Digital currencies, programmable money, and central bank digital currencies are emerging on the horizon, each of which could give monetary authorities even finer-grained control over how money flows through the economy. Imagine a world where a central bank could not only set the price of money, but also decide where that money is allowed to be spent, or how quickly it must be spent, before it loses value. The technology to do this already exists. The political restraint not to use it is the only thing standing between today and that future. And that is a deeper story behind interest rates. They are not really about percentages on the screen. They are about who has the power to shape the future of every household, every business, and every country, and how that power is being quietly consolidated, decade after decade, into fewer and fewer hands. The next time you hear a routine news headline about a quarter-point rate hike, remember this: you are not hearing about an abstract financial number. You are hearing about the most powerful lever in the modern world being adjusted by a small group of people in a quiet room, on your behalf, and without your vote. If you found this breakdown valuable, watch our deep dive on inflation as a hidden tax next, where we expose how the value of your money is being silently drained even when prices appear stable. The link is on screen and in the description. Until next time, keep watching the levers others want you to ignore.